But at least we know our taxes are going to good use, right? And most people don't even know how to properly save on tax. So they end up tipping the government. Like, I like tipping, right? Tipping is a great way to say, thank you. Job well done. Not something I associate with the government. It's like tipping a waiter who ate 39.6% of your meal and peed in your soup. One of the biggest expenses we have in our lives, well, it's taxes. Now, some of it is an investment towards services we use on a daily basis. Taxes can fund areas that create safety and infrastructure, the types of services that benefit our lives. And some of it goes to places that aren't so helpful because of bureaucracy and waste. You hear statements like, tax the rich, that's what they say, right? Or are people paying their fair share? Well, that's another question. But either way, I want you to know how to stop the leaks. I want you to stop tipping the government and only pay what you truly owe. In this video, I'm going to share the framework on what you can do to save money legally and ethically. First, and this is critical, best tax advice I can give, better than any tax shelter or any idea around taxes, it always makes sense to earn another dollar. Now, I know people that said in the past if they earn more money, it would kill them with taxes. They'd get killed with taxes. That's from my hometown, I'd hear that, with coal miners that had to work overtime. There's some key distinctions to really understand. Consider this a public service announcement or a commercial, if you will. You know, the one that ends in, the more you know, with the little rainbow that comes across. There's marginal rate with your taxes and there's average rate. So to keep the math simple, if you made $100,000 and you paid $17,000 in tax, that's a 17% average rate. But the marginal rate says, well, the first dollars you earn up to a certain amount, let's just say $30,000, is only taxed at 10%. No matter how much more money you earn, those first dollars aren't going to be taxed at a higher rate. So it's a step, right? And then the next step is another kind of, range. And maybe that's $30,000 to $70,000, you might be paying 15%, but it doesn't tax the previous dollars higher. Then the next step is, well, maybe you go up to 25% for the rest of your money. So on average, you're at 70%, even though your marginal rate might be 25%. So that's good news. It means you can always earn more money without impacting your previous dollars or raising the tax rate. And here's even better news. When you save tax, it's on the last dollar you earn, meaning at your highest marginal rate. So you're going to save the highest percentage when you go through tax strategy. So let me say this again. Earning another dollar is always your best bet with taxes. Pay more taxes by earning more, and you'll still have more money in your pocket, even if you pay the government more. This will add more value to society, to yourself, and actually improve the world. The best way to help you save on tax is by giving you a framework. The laws are different in each country. The laws change from year to year as well. So unless you love reading tax code, and I know there's probably people that do, or legalese, I want to ease your mind with something that can cut through the noise and help you keep more of what you make. This framework is built with 3 buckets. So if you have some paper or an iPad or something, I want you to draw 2 vertical lines so you have these 3 different sections, and let's go. The first section or the first bucket is your team. The second one I want you to label is deductions, and the third is reclassification. Okay, let's start with your team. Now, there's up to 4 people you might have on your team. Now, if you're just starting out, or maybe you're a student, you don't have much money, maybe you're the person. But as you start to gain momentum, as you have profitability, I want you to make sure you have timely data. So the first person on your team is either a bookkeeper that just goes through and says, here's what your expenses are and here's what your income is, right? In business, they track your profit and loss, or if in personal finance, just your overall banking, right? Or if you're a business that has payroll, maybe you hire a controller. So they're doing bookkeeping and they're handling payroll. Or if you're a bigger business, it might be a CFO. Right, that CFO is a financial officer that can use pro formas and do projections and look at your margins. So very, very critical to have timely data. If you're getting your data together like I did when I was 19 years old, on April the 14th, I'd open the shoebox and what are all the receipts that I had? Not very good. There's apps that are out there. There's plenty of easy ways to do this. The way that I do it is we just use QuickBooks because I'm a business owner and I just look over that and have a printout that I look at every single Monday. Now, the second person on your team, very important person, is a tax strategist. This isn't always a CPA if you live in America. there's enrolled agents, there's even just people that were tax lobbyists that might be really good at navigating this, or even entrepreneurial thinkers that have an emphasis in tax. Sometimes people on the tax side are more historians telling you what to file, looking retroactively at what you've earned, versus a strategist which proactively navigates your deductions, which is going to be that second bucket. The third person on your team is an attorney. If you have a side hustle or 1099 income or a business or a bunch of real estate, you want to set up the right corporation. Not only will it help you from a liability perspective, but it can also help you from a tax perspective. And if you are a business owner without a corporation, you have a 400% higher chance of being audited and unlimited personal liability. So you can protect liability and tax. Now, if you're making millions, you want a tax attorney. It might just be a basic corporate attorney if you're just starting a business or you don't have a huge amount of revenue coming in. And finally, this is an option only really if you have a commercial property. Maybe you have a business and you office inside of a property that you own, or maybe you own fourplexes or bigger. Then you might want a cost segregation engineer. They can work with your tax strategist and do an analysis that allows you to accelerate your depreciation for tax purposes with your real estate. Once again, commercial real estate. So that's the team. Bookkeeper, controller, or CFO. Number one, timely data matters. Number two, tax strategist to proactively help you navigate your taxes. And I'm going to tell you at the end of this video how often you want to meet with them. Third is an attorney, either a corporate attorney or if you have more money, a tax attorney. I just met with a tax attorney today, specializing in intellectual property. And fourth would be an engineer, cost segregation in particular. Excuse me for just a second. I know I'm interrupting your video, but it's because I'm really excited about this. Disrupting Sacred Cows, my newest book. It's new, it's fresh. It's about all of the things that have to do with our relationship to money, the things that hold us back, and how to, kind of peek into that, be able to resolve that. And ultimately, with the new economy and everything that's happening and moving so quickly, it is timely to help you to have more success in your finances. So go ahead and click the link if you want to grab this book and dive on in. Now, it's awesome if these different people on your team communicate with each other, or if they have all this in-house, even better, but sometimes they need to collaborate in order to maximize everything that's going on. So let's go to the second bucket, and here's where I'm going to put a bunch of money in your pocket, especially if you're a business owner. This is deductions. So if you own any business, a side hustle, you have 1099 income, you have a business, ask any time you're spending money, could it connect to your business? And if it does, document. Now, maybe not everything is going to connect to your business. I've taken trips to Italy, but I got to write off part of that for my annual corporate meetings by doing our corporate meeting there. I've bought a Can-Am, which it looks like a Batmobile, and I can write off a portion of that because in my podcast studio, when I have my guests, we go out for rides on that. It's in the opening credits in the videos. So there's a portion I could write off, but that comes from having these meetings with the team and saying, in what ways could we write this off and does it count or not? Now, here's examples of deductions, and these are major ones. Right now, at the time this video is released, it might not be around in the future, is employee retention credits. If your business was impacted by COVID, you had COVID and an employee had COVID, the rules are they're not very stringent. They're kind of loose. You can get like $6,000 for 2020 per employee in credits, and then up to like $21,000 in 2021 for employee retention credits. I was just talking to someone that gets $1.8 million in employee retention credits. $1.8 million. That's substantial. So obviously they have like 900 employees, but this has even worked for someone with just a couple employees. If you have W-2 employees that aren't related to you, that's something to check into. Number two, R&D credits. Have you ever built a website and used people domestically to do that? Have you, built an app or improved your CRM? You might have R&D credits coming to you. And if you've missed them, you can go back and get them from the past. Here's another one, the Augusta rule. Maybe you have a home or a cabin and you do things for the business every now and again. Well, when you do that, you can write that off for up to 14 times a year by renting it to your business and not have to pay income tax. So it's a deduction without the income tax. Home office, that's something that for some reason a lot of accountants miss, but that can mean part of your utilities and a portion of the home can actually be a write-off for you. There's even a code for pool and gym maintenance. If you have that inside of your home, which I have both, and I'm able to write off the maintenance for that, or Section 199A. Section 199A says it's a pass-through pass-through deduction that says based upon your income and employees, it reduces your income because of a credit for earned income, 199A. If you don't know about that, that could be huge. So those are just a few examples of deductions, and a lot of people miss these because a lot of accounts are really busy. They've just got a lot of things that they're filing, and they get paid per filing, and so often they don't really have a lot of time to talk to people, so you want to make sure to have the right people on your team. Now, this is the big one, because we started with the team, which can be a little bit hard to kind of, get the right team. The second thing is really deductions, which a lot of people think about their deductions, but this is the part that most people miss, and this is called reclassifying your income. And there's 4 different ways to reclassify your income. The first is taking active income and making it passive. I'll give you some examples. The second is taking ordinary income and making it capital gains. The third is tax-free income, kind of nice. And the fourth sounds really complicated. It's not. It's called tax arbitrage. We'll talk more about what that is here in a second. So let's look at this. Active to passive income can mean, hey, if I'm an S corporation, I can take a salary and I pay, all sorts of taxes on that, including self-employment tax. But if I take distributions on anything above my reasonable salary, I don't have to pay somewhere between 3.2% and 15.3%, depending on how much income comes through there, simply because it's now classified passive. Or investment income, 1099 income, doesn't have all that self-employment tax, again, saving you between 3.2 to 15.3%. So the second way to reclassify income is take ordinary income and make it capital gains. I've done this because I have a business, and so in selling my business in 2021, that was capital gains. Long-term capital gains was not quite half of what ordinary income was, but it was quite a bit lower, so that was super helpful. If you're doing business internationally, you can look into an ICDISC, or an international sales corporation, and the money you bring into America from other countries, that could be capital gains. Or there's something called an 831B, which is a captive insurance agency, which I happen to have one, which allows me to have my own insurance. So when I'm out there speaking and doing these videos, I can insure those things rather than using an insurance company. The money goes in pre-tax, and if I don't make a claim, which I have made one during COVID, because I went from speaking all the time to staying home. And my wife's like, are you ever going to leave the house? I mean, I love you, but she thought I was here a little too often. So now she really supports me going out on tour and doing some comedy and then missing me a little bit, and I come back. So I'm able to put money into that pre-tax. If I don't have a claim, I can take it out capital gains. It's just an example. There's a higher audit risk with those. There's a lot of people that abuse those, so you have to be really careful. I'm just giving you examples. The next thing is tax-free. Let's say, again, you're a business owner and you have a C corporation and it's been around for at least 5 years. You might be able to sell that up to $10 million tax-free through Section 1202. Or a charitable trust where you can donate a highly appreciated capital gain asset like a business, a piece of real estate, or a stock, and donate it and get a partial tax deduction for the donation, sell it, pay no tax, and then get income off of that during your lifetime, leaving around 10% or at least 10% to the charity. So instead of giving the government money, you give it to a charity. There's even donor-advised funds that you can look into. Now, tax arbitrage, and this is important, means I spend $1 and I get more than $1 back. A lot of people let the tax tail wag the dog. They go, I'm going to go buy something to save tax, but they spend $1 to save 35 cents. So they've really lost 65 cents if it wasn't something they would have bought otherwise. So think economics first, tax second. But tax arbitrage, I have some art to the right of me that I was able to buy a big, collection of art that I then, after 3 years, started to donate that art, and I got to write off the value of what it was appraised for at that time, which was much higher than what I paid for because I bought it in a collection. Or there's something called a historic easement, where you can buy properties and you protect the facade of that to keep the historic facade, and you can still rent it out or utilize it, but you get an easement that accelerates this tax advantage for you. There's things like conservation easements that are similar, but again, be careful with those. Some of those have been abused, but you basically give up your development rights so that you can't tear it down and do something different, and you get a tax advantage for that. So here's your tax framework. Build the right team, maximize your deductions, and then reclassify your income. Now, the way to utilize this framework is a 3x3x3. So number 1, 3 buckets. Number 2, every 3 months you meet with your team and just say, hey, here's where we're at with income, here's some ideas, and what kind of strategies can we bring up? These bring me so much strategy. I just ask questions like, what's the coolest thing you've done for any other client? Or is there anything new that's out there? Or can I write this off? And sometimes they laugh because I ask about writing off absurd things, and other times they can actually write it off. And then every 3 years, look back to see if you've missed something. We mentioned R&D credits. But there's also something called net operating loss, which is when you're a business, usually you can only write off about 80% of your operating costs against your income. But because of COVID, there were times where you could write off 100%. But even better, you could mix and match. A year that was really profitable with a year that was high expenses, you can mix and match and get more write-off. Therefore, go back and reclaim money that's rightfully yours. So this tax framework is, once you understand, it's about the right team, it's about maximizing deductions, and then it's about how you classify your income or reclassify it. It lets you keep more of what you make without having to read the tax code, without having to know everything that's out there. So hopefully this is helpful, and we've got other great resources and videos if you want to know about how you can pay your kids. I just was in the bank with my kids today, setting up accounts because I've got my oldest son filming and editing videos for me, my youngest son opening for me on my comedy tour, and so it's really cool that I can actually pay them and pay no tax. Get a tax deduction for me, tax-free to them, and yet I'm still in charge of those funds. So they're not just out there buying huge amounts of candy or video games. So there's still a lot of lessons that need to be taught there. So hope you enjoyed this video and this framework. I hope it puts a lot more money in your pocket and wealth in your life and gives you a lot more certainty when it comes to the crazy topic of tax.
You know what I really like is comments. Even if they're harsh, even if it's making fun of my hair or how much I interrupt people. But what I really appreciate is thoughtful questions in the comment sections that provide content and ingredients for me to share. Some of my favorite things to do. So if you want more, if you want something personalized to you, go ahead and type that in and click to this next video where I've done this for other people to give you an example.